Hello, this is Dr. Nunez. Welcome to the ACC 350 Exam 1 review on chapters 1 and 2. So in chapter 1, we started out with cost classification, classifying cost based on initially whether they are direct cost or indirect cost. And the fundamental difference between the two is whether or not you can trace them. Direct costs can be traced to the cost object. Indirect costs cannot be traced to the cost object. That is the fundamental difference. And then we also move to classifying costs based on whether or not they are related to manufacturing or not related to manufacturing. The costs that are related to manufacturing, we call them product costs. And there are three categories: the direct materials, the direct labor, and the manufacturing overhead. So when we ask ourselves a key question, which is the cost related to manufacturing or not? If we determine that it is a cost that is related to manufacturing, then it has to fall into one of these three categories. Those direct materials that we can trace and we choose to trace, the direct labor that we can trace and we choose to trace, it's also called that touch labor, and then the manufacturing overhead, which would be everything else. And then the non-manufacturing costs, the period costs, the selling and administrative costs. So the product costs are going to flow through to that income statement, but first they go to the balance sheet. They go through the inventory accounts and then to cost of goods sold on the income statement, whereas the period costs go immediately to the income statement. And one of the things that you really want to do is go back and take another look at chapter one, at the chapter one application assignment. There's a lot in that assignment that you need to be very comfortable with, and I've reproduced a couple of the problems here. But in chapter one, we also looked at cost behavior. And cost behavior is important because it helps us to be able to plan and predict our costs. And there are three basic patterns that we looked at. One is variable costs. And in total, the variable costs are going to vary directly and proportionally with the activity, but they're going to be constant on a per unit basis. A good example would be something like direct materials, right? The more you use it, the more it costs you. So the total is going to vary, which means as the activity or the volume increases, the total variable cost is going to increase, right? If the volume decreases, then the total variable cost will decrease. And it's proportional, which means that as the activity increases, the total cost increases at the same rate. So if you had a 10% increase in your volume or your activity, you'd see a 10% increase in your variable costs, but the per unit stays constant. And fixed costs, well, they're just the opposite. Total's constant, but the per unit is going to vary and it's going to vary inversely. And then mixed costs, well, they're going to vary directly, but it's not going to be proportional. And it is going to be inversely on a per unit basis. Again, you want to go back and take a look at chapter one. We did look at cost behavior patterns, and I've got a problem here where I'll focus a little bit on cost behavior patterns as well. And then another one that you might want to take a look at is the chapter one in class problem number two, and I think I've reproduced that here. So in looking at the application assignment, you do want to make sure that you can classify costs as either being, product costs, right? The materials, the labor, and manufacturing overhead, or the period costs, which would be everything else, everything non-manufacturing related. And the key to the direct costs is that they're traceable. The materials are going to be traceable to the cost object, to the computer. The labor is going to be traceable to the cost object, and it's that touch labor. And those things that are not related to manufacturing, well, they're going to be selling or admin. For example, advertising. That's never going to be a manufacturing cost. And then, sales commissions. That's never going to be a manufacturing cost. So we can identify those non-manufacturing costs because they're not related to manufacturing. And then we've got this touch labor, the assembly shop supervisor. The touch labor is supervised by the supervisor, but the supervisor never touches the product. So it's not direct labor, it's indirect or manufacturing overhead. And then the company's accountant, again, not related to manufacturing. So it would be one of those, period costs. And then depreciation, while it is related to the manufacturing, it's not traceable. And so it's going to be overhead. And then we also looked at classifying based on period versus product cost. And again, you want to ask that key question, is it related to manufacturing? If it is, it's a product cost. If it's not related to manufacturing, if it is a cost that is not incurred during the manufacturing process, well, then it's just a period cost. So for example, depreciation on the salesperson's cars, that's not manufacturing related, it's a period cost. Rent on equipment used in the factory, well, it's used in the factory, it's a product cost. Lubricants used for machine maintenance, it's related to manufacturing, it's a product cost. Salaries of personnel who work in the finished goods warehouse. It's important that you understand here that finished goods is at the completion of the manufacturing process. So you incur all these materials, labor, and overhead costs during production. Once you complete production, you don't have any more product costs. So once the goods are completed and they go to the finished goods warehouse, you're only going to have period costs at that point. So what's in the finished goods warehouse, the personnel that's working in that warehouse, those are period costs because they're not related to manufacturing. The manufacturing is complete. That's why the goods are in the finished goods warehouse. And soap and paper towels used by factory workers at the end of the shift. It doesn't matter whether it's the end of the shift, the beginning of the shift, or the middle of the shift. It's used by factory workers. That's why it's a product cost. Factory supervisors' salaries, well, product costs. Heat, water, power consumed in the factory, product costs. Materials used for boxing products for shipment overseas. This is happening after the production is completed. Right? They're boxing up products for shipment. The units are not normally boxed. That's a period cost, right? Just like the finished goods warehouse is a period cost, happens after production. Period cost happens after production. Period cost. Advertising is just a period cost. Workers' compensation for those factory employees, well, the factory employees, product costs. Depreciation on tables and chairs used in the lunchroom related to manufacturing indirectly, but related to manufacturing. It's a product cost. And the wages of the receptionist in the admin office is not related to manufacturing, period costs. And leasing corporate jets, that's a period cost. Cost of renting rooms at a resort for the sales conference, not related to manufacturing, period costs. Cost of packaging the company's product. So the distinction between, what we have here in 8 and 15 is worth noting. So in 8, this happens after the units are produced, right? The units are not normally boxed. So they get to this into this process and they're getting ready to ship some product overseas and they got to package it up specially, right? It's special packaging. The product's not normally packaged. That it occurs after the manufacturing process, hence the period cost. Whereas the cost of packaging the product, well, that happens during manufacturing. That's a product cost. Okay, so anything that happens during manufacturing is a product cost. Anything that happens after manufacturing is a period cost. And then I added one. This one is not in your handout, but it was in your application assignment. So I do want to spend just a little bit of time on this to emphasize some of these key cost behavioral concepts. So earlier, and let me just scroll up here. I summarized those behavioral patterns. Variable costs are constant per unit, they vary in total. Fixed costs are constant in total, vary inversely per unit. So in an exercise like this, you've got to start by applying those concepts. So for example, let me switch to typewriter mode here. So for example, the fixed costs are 470,000. Fixed costs are constant in total. That's why it's 470 here and 470 at the other two activity levels too, right? Because the fixed costs are constant and they're not going to change, right? So we can predict those fixed costs at all activity levels because they're constant in total. And then the next thing, given that we know what these costs are, the total costs are at 68,000, we can easily figure out per unit. The per unit is just going to be the total variable cost divided by 68,000. The fixed cost is going to be 470 divided by 68. So again, what we can do here is take the 2244, and we're just dividing by 68,000, right? You're just going to divide by the units to get a unit cost, right? And same thing for fixed costs. You're going to take that 470,000 and divide by the 68,000. And you're going to end up with 6.91. right? So we can easily calculate a per unit cost. Just take the total of that cost and divide by the number of units, right? And we can do the same thing for the fixed costs. It's 470 at all activity levels, right? So we just want that 470 in this case divided by the 88,000, right? Anytime you want a unit cost, just take the total of that cost divided by the number of units. And same thing here. It's the 470, right? But now we're going to divide by 108,000. So we're just using the basic concepts. Fixed costs are constant, right? And another thing we can apply here is variable costs are constant. If it's 330 here, then it's 330 here, and it's 330 here, right? That's pretty easy, pretty straightforward, right? Fixed costs are constant, variable costs are constant per unit. And we can, I didn't put in totals here, but I mean, I didn't put in the per unit, but I probably should have. So that's 5.34. And 4.35. It's pretty easy. And then of course we can add these and we'll have the total cost per unit. But we haven't finished the variable cost yet. So given that we know the variable costs are 330 per unit, all we have to do is take that volume level and multiply it times the cost, right? And that'll give us the cost at that level. So 108,000 times 330. And that will give us all the pieces. And we just have to use a little basic math to add in the total, add in the total, right? But that will give us what we need. And same thing at the bottom, add in the total, add in the total. And we have our cost behavioral assumptions being applied, easily applied. And I've got the finished chart down here so that you can check your work. Next thing, in chapter 2, we looked at cost volume profit analysis. And there were some key measures that we need to be able to calculate, like the price per unit, variable expense per unit, contribution margin per unit. And then some key ratios, the variable expense ratio and the contribution margin ratio. Now we looked at break-even Q, break-even dollars, target Q, target dollars, margin of safety dollars, margin of safety percentage. Those are all things that you want to make sure you have committed to memory and you're able to calculate those easily on the exam. And I do have so when you're studying, you want to make sure that you do have these committed to memory. Break-even Q, for example, is the fixed cost divided by the unit contribution margin, right? The break-even dollars is the fixed cost, right? Divided by the contribution margin ratio, right? So you want to have all this committed to memory. And then target Q, you're just adding in the profit to the numerator and dividing by unit contribution margin for Q, the contribution margin ratio for dollars. And of course, the margin of safety, one of the last things that we looked at in this chapter. Margin of safety is just the difference between the actual sales and the break-even sales. And I've got all the calculations down here for these two exercises. So, if we need to be able to determine the price, variable expenses, and contribution margin per unit, then we're just going to take the totals divided by the number of units. Right, so if we take the 20,000 units divided by 1,000 units, 12,000 divided by 1,000 units, 8,000 divided by 1,000 units, we've got the cost per unit. And the ratio, of course, is just contribution margin divided by price. And we've got a what if question. Um, if the sales increase to 1,001, how's the income going to change? Well, if you add another unit, then what you're adding is contribution margin, right? $8. That's how much income will change without seeing any changes in your cost structure. And kind of the same thing for in class problem number one. So needed to be able to find the contribution margin per unit, contribution margin ratio, variable expense ratio. So we did some of the same kinds of things in this exercise, and I've got the solutions down here for you to work through. So that's pretty much it. And exam one will have four problems on it. Bring a calculator. You will not be allowed to use the calculator app on your phone. And happy studying. Hope you all do well on the exam on Monday. Take care. Bye.